Hello friends, today I have come back to discuss three evergreen stocks which you guys can invest in, and it is a SIP grade stocks. What does that mean? That year and year, month and month, week on week, you can invest in these stocks which can prove to be a multiple compounder and which can give you a steady growth, right? But before that, let me announce that I'm not a SEBI registered research analyst, so hence all of these stocks are only for educational purpose. I am only discussing this for you guys to know how good these stocks are. This is not a recommendation. Please consult your financial analyst before investing in any stocks. Having said that, now let's go and quickly discuss about these stocks. What are evergreen stocks? The evergreen stocks have good growth metrics. What does that mean? The top line, there is a huge growth. PAT, which is profit after tax, has a huge growth. The EPS has a huge growth. Historically, these stocks should be able to maintain good growth in all the financial parameters. Second thing, the business mode should be solid, rock solid, and there should be all type of quality checks around these companies, and it should be strong in pricing power, innovation, favorable sectoral tailwinds. Everything should be looking strong so that none of the competitors will become unable to invest in these businesses, would be able to start with these businesses as soon as possible, right? So your business has a strong moat which will prevent the competitors to enter into that sector. It should be SIP grade. That only defines it as evergreen stocks. What does it mean? Ideal for consistent monthly investing or building core portfolios during temporary market setbacks, right? Having said that, now that we have defined what are evergreen stocks, let's see what is the first company. The first company is none other than Bajaj Finance. And you would be thinking, hey, this company everybody is discussing, everybody is telling about Bajaj Finance, and is it still a multibagger? It's still a consistent compounder? The answer is an absolute yes. It's a juggernaut in the financial services space. None of the other company even comes closer to this. Even after so many years, Bajaj Finance has been a very strong company to invest in and get a very good growth still out of it. Right? Let's look at the 19-year financial track record. The first metric I'm looking at is AUM, the asset under management. This decides how big the company is, how consistent the company is, how dependable the company is, how many people are actually trusting this company to be a large company. The asset under management has a growth of fantastic 34% year over year for the last 19 years. That means there is a consistent base expansion. Customer franchisee, it's a 32% CAGR over the last 19 years. What does this mean? This means massive loyalty ecosystem. Net total income has grown by 33% year on year. What does this mean? Superior top line compounding. Profit after tax has grown 46%, friends. 46% in the last 19 years. What does this mean? This is a compounding powerhouse which will be a great addition to your portfolio. Now, if you look at the different efficiency parameters, the biggest efficiency parameter in case of a bank or NBFC is the return on assets. It's not return on capital employed, but it's return on assets. It has an astounding 4.3%, which is really, really good. Return on equity is 18.1%. Anything above 15% is always good. Net NPA is 0.41%. This has a very less potential to turn into bad assets. So it is only 0.41% of its total portfolio which is bad assets, which is really good, a really good benchmark among all the NBFCs. Now, from mid cap to large cap, there was a huge journey that the Bajaj Finance as a company has gone through. The company is experiencing natural growth normalization right now. So, if you see the company when it is going from a small cap to mid cap, will have a larger growth compared to mid cap to a large cap. Okay? So the loans has grown by 25% over the last 19 years, whereas it is growing by 21% in the last 3 years. This is bound to happen because the big company would not be able to grow at that pace which a mid cap company would do. PAT has grown over 56% in the last 19 years, whereas it is growing by 20% last 3 years, which is really, really good by any standards when it has the company of the size of Bajaj Finance. What is the key takeaway? Still compounding at 20% even on a higher PAT base of 19,000 crores. This signifies that this is a really, really good company. Management's long-term guidance. Let's look at what the management is proposing that this company would be happening in the coming years. AUM growth, it is the target range is from 23 to 25%, which is really, really good. That means every year it is going to grow by one fourth. Profit growth, aiming for 23%. Asset quality, gross NPA less than 1.4%, net NPA less than 0.5%, which is industry benchmark. Profitability, which is return on asset, is 4.3 to 4.7%, which means solid parameters and the guidance given by the management. What is the primary mode? The primary mode is the customer franchisee. It has 119 million, which is around 12 crore total customers. So it can cross sell any of the products that it wants to the existing customer base. 63% of the customers are eligible for cross sell of the products. This data advantage allows Bajaj to sell mortgages, personal loans, insurance at zero customer acquisition cost. So you have an existing customer. You don't need to acquire that customer, but the existing customer would want different other products. Hence, you can sell them any other product that you have in the portfolio. What is the strategic shift in distribution? You see, Bajaj Finance has gone with on an alliance with Airtel. Airtel has a huge customer base of around 38 crores. So, Airtel and Bajaj Finance joint venture is going to leverage 1.2 million distribution points. It will have an access to 38 crore customer base of Airtel. So this is going to be a huge shift. So what is the next strategy for Bajaj Finance? Bajaj Finance has been positioning itself as Bajaj Finance 3.0, which is Fin AI. Earlier it was a fintech company, now it is positioning itself as a Fin AI company. What it is saying? It is saying that AI is everywhere, moving from fintech to Fin AI, integrating AI in risk, credit, design, and ops. Automation, launching 800 plus autonomous agents across HR, IT, and risk in the next 18 months. So, Bajaj Finance has been using AI to convert a lot of their customers, cross sell to a lot of customers. They are processing 20 million calls via AI text conversion, generating 1 lakh new loan offers for 5.2 lakh customers using predictive AI. This is huge. So that means Bajaj Finance is leveraging a lot of technology to convert and cross sell the products to their customers. What is the growth runway? So right now, if you will be surprised by looking at the current market share of Bajaj Finance, it's only 2.5%. What does this mean? This means there is a huge runway that is available for Bajaj Finance to acquire more number of customers, to increase the business, take on the market share. The potential is huge. Despite 20 years of dominance, Bajaj Finance holds only 2.5% of the Indian credit market. And the industry grows at 12%, but Bajaj Finance is giving a guidance of 22% year on year growth. Right? And if you look at the valuation context, the 10-year median price to book is 8.1, whereas right now it is trading at 4 to 5 price to book ratio, which means compared to the history, it has been at a cheaper place. So, what is the view? The view is that the valuations have cooled off significantly, but the moat remains intact. What does that mean? There is still a scope to invest in this stock. What is the second company? Let's look at the second company, which is TVS Motors. This is the fastest growing player in the two-wheeler segment. You would be seeing a lot of companies in the two-wheeler space: Hero, Honda, TVS, any Suzuki, then Yamaha. But TVS Motors has been standing out among all these players in terms of the growth, in terms of the moat, in terms of the valuation. Let's look at the automobile sector dynamics. The upgrade narrative. India is upgrading, right? The disposable income is increasing, and there's a lot of drivers who are upgrading themselves from bicycles to motorcycles, motorcycles to cars. The two wheelers remain dominant position. 70% of the sales contribution comes from the two wheelers. There is an ongoing shift to the premium, which is to the more than to 125cc segment. Right? There is also a EV transition that is coming into play. So there is 10% EV contribution by 2026. The growth trajectory, if you discuss about a little bit about the TVS, in 2017 the EVs were only 2.39% of the sales. By 2026 they aim to reach 10%. The government pushes and tax benefits are accelerating this adoption curve, which is only being beneficial for TVS. Let's look at the policy tailwinds. And let's take Delhi as an example, right? There is a mandatory EV transition which is taking place from 1st of April 2028. Only EV motorcycles will be registered in Delhi. There are massive subsidies which is to the tune of 6,000 to 10,000 per kilowatt depending on battery size. What are the implications because of this? The state-led bans on the ICE, which is internal combustion engine, will force 100% EV market in the near future. And if you look at the current infrastructure in India, which is supporting the EV, it has only been growing. There are a lot of places where there are new charging stations supporting infrastructure, which is going to be in place, which is in turn going to help companies like TVS grow their market share and also help in the adoption of EV across India. Let's look at the GST reforms, which is powering the EVs. So if you look at the ICE vehicles, which is internal combustion engine vehicles, the GST rate is 28%. EV vehicles, the GST rate is 5%, which is a big push from the government in terms of the tax reduction, which is pushing the customers to buy the next EV. So if you see the EV market leadership, TVS Motors right now is leading the margin. Bajaj Auto is aggressively scaling, and Ether Energy is the tech first. So these are the different modes of these companies which we should be looking into. Now let's look at the TVS product strategy. The TVS product strategy is threefold. The first one is R&D focus. There is a heavy investment in EV drivetrain and battery management systems, which is happening in TVS. The second strategy is the premiumization. There is a domination in 125cc segment with Apache series. Fast growth in Jupiter scooters is also next round in the corner. There is also the third strategy, which is called the global reach. 25 to 30% of the sales comes from global exports, which is diversifying the currency risks at the same time. Let's look at the 3-year financials. If you look at the revenue, there is a 11.1% of CAGR growth, which what does it indicate to? This is indicating that there is a growing, uh, so the sales are growing via the premiumization. Volume, there is a growth of 8.8% year on year. What does this show? This shows there is a steady market expansion. EBITDA margin, there is a significant growth from 10.1% to 12.3%. There is a PAT growth of 22% year on year, which shows that there is superior earnings compounding, which this stock provides. What is the pricing power indicator? There is a 2.3% increase in the pricing power. If you see the revenue CAGR, that is 11.1%, but the volume CAGR is 8.8%. So what does this mean? There is a pricing power advantage that the TVS Motor as a stock has. Uh, the TVS Motor as a company has. So this delta of 2.3% proves that TVS has the pricing power to pass on the cost to the customers, and the customers are also happy to buy a TVS vehicle with the pricing changes. So, what is the indication that is coming out from the February 2026 conference calls? Scooters growing faster than the overall industry average. Premium and super premium, which is more than 125cc vehicles, is the growth engine. And the third point that came out very significantly, and I was attending that conf call, is that the entry level segment of 100cc remains stagnant or decline. So the heavy focus is on the vehicles which is greater than 125cc. The valuation premium, the trailing PE ratio for TVS is 56, and what does this indicate? Growth commands price. TVS trades as a significantly higher PE compared to the peers because the EPS is growing at 22%. Investors are ready to pay this PE. With the current pricing being high, still the investors are ready to pay for it, right? What is the third company and the last company? This is none other than Mahindra and Mahindra. In any tier 2 city that I have gone, and Mahindra has a very significant road presence. There is a lot of vehicles which is from Mahindra and Mahindra category. Right? This has transformation has happened to an industrial giant. If you look at the return on equity, there is a significant recovery from FY21 to FY26. It has gone up from 4.4% to 20%. I'm talking about the return on equity. There is a massive recovery that has happened over the last 5 years. If you look at the earnings per share, the 5-year EPS CAGR is astounding 63%, and you would be seeing that also. If you go onto the road, there is Thar Rocks, there is Scorpio N, there are beautiful electric vehicles that comes from the Mahindra and Mahindra group. So if you look at this 63% 5-year EPS CAGR, that if you look at the trajectory from 16.2 rupees in FY21, it has gone to 115.7 rupees in FY25. Mahindra and Mahindra has become one of the most consistent earning compounders in the Nifty 50. So if you look into the profit breakdown, there are three important businesses which this company, the Mahindra and Mahindra has. What is the first one is the farm business, which is basically the tractors and the other farm components that the company comes up with. Second is the services, and that is driving around 36% of the revenue, which is Tech Mahindra, M&M Finance, Life Spaces, and Lifestyle. That is the third one is the automotive with 25% dominance in SUVs, LCVs, and last mile mobility. Look at the cash flow hierarchy. The services has 39% cash generation. The farm business has 32% cash generation. The auto segment has 29% cash generation. This indicates that all of these businesses are growing at an astounding rate, generating a lot of profit for the company. So if you look into the auto business focus, leader, Mahindra and Mahindra has come out of clear leader in the SUV segment. There are a lot of vehicles which has a great road presence. The strong presence in the three wheelers, that is the last mile mobility. Significant LCV, which is trucks and buses, which is having a good market share. Wait lists on the flagship model like XUV 700, Scorpio N, Thar Rocks shows massive demand in SUV. Right? Let's look at the farm business mode. Mahindra and Mahindra is a global leader in the tractor volumes. GST reforms are likely to favor the farm mechanization, and market share remains steady at greater than 40% in the Indian tractor market. Let's look at the services ecosystem. The Mahindra group leverages its group companies for massive value creation. If you look at the Tech Mahindra, it is providing the IT services. You look at the Mahindra Finance, it is providing the financial services. You look at the Mahindra Life Spaces, it provides real estate services. You look at Club Mahindra, it provides hospitality and lifestyle services. Now let's look at the organic growth targets that has been given out by the company. Look at the past, that is from FY22 to 25, the organic growth reached around 25% CAGR. Whereas the future, if you look at the future focus, which is from FY26 to 30, the target is 15%, which is at the lower side, and 40%, which is at the higher side. What are the future growth guidances? The minimum organic growth is 15%. Aggressive segment targets are up to 40%. The ROE target, the return on equity target, is 18 to 20%. Capital allocation is disciplined exit from loss making units, which makes it a very, very good company, robust company to invest. What are the short term risks? The risks are the inflations, the interest rates, the geopolitical wars, right? Because this is going to affect each and every sector. Inflation is going to affect everything. Interest rates and geopolitical wars are also going to affect everything. So hence, this has also been the risk for Mahindra and Mahindra. What are the opportunities? The short-term pressure on the stock price is an entry opportunity for all of us. So look at the PAT growth that is happening of 20 to 25%. Hence, this proves that this company is a steady compounder which can be trusted because of the diversified business lines. Look at the M&M valuation. The current PE ratio is 24.1. The median last 5 year median PE is 26.5. It is slightly under the median PE, and it's your own decision. You can still wait for a little bit for the stock to cool off, where you can make a good entry. But if the currently it's trading below the 5 year median, while the monthly sales number might show temporary slowdown, the long term compounding story is very much in intact. So that brings me to the end of this whole discussion. What are the three companies we discussed? Bajaj Finance, TVS Motors, and Mahindra and Mahindra. Each of are the sector leaders in their own spaces. Take your own decision. Consult your financial analyst, and I am hoping that you guys would be definitely investing in these companies. Thank you.